If a lender told you you don't qualify, they may have been right for a conventional loan, but there's a whole category of loans most retail lenders can't offer, and it might be exactly what fits your situation. Let me introduce you to non-QM. Non-QM stands for non-qualified mortgage. My simplest definition, it's the category of loans that doesn't fit the conventional box as defined by Fannie Mae, Freddie Mac, and other government regulation agencies. Those agencies set the standard rules for what qualifies as a conforming loan. Anything outside that box, that's non-QM. Now, I need to address the biggest myth right away. Non-QM is not subprime. It's not predatory. The angst is out there and it's outdated. These are legitimate, well-regulated loans built for borrowers whose situations don't fit the standard forms, not for borrowers who can't actually afford a mortgage. Non-QM exists because the real world is more complicated than a Fannie Mae rubric. Self-employed borrowers with legitimate income, investors who use rental cash flow, high net worth folks whose wealth is in assets, not W-2 paychecks. These people all deserve mortgage options. Non-QM is how they can achieve it. One quick note on access. Most retail lenders don't offer a lot of non-QM products. It's not a marketing pitch, it's just how the system works. As a broker with over 100 lender relationships, I have access to non-QM specialists that a retail loan officer or a bank simply can't reach. So, who are these loans actually for? In my practice, my non-QM business is roughly split between 50-50, two main groups. First, self-employed borrowers, business owners, contractors, gig workers, freelancers. People with strong actual income, but tax returns that don't reflect it because of legitimate business deductions. Small business owner reality. Second, real estate investors. Folks buying rental properties whose personal W-2 doesn't matter as much as the property's ability to cash flow. Traditional conventional loans limit investor property purchases. Non-QM, specifically DSCR, opens that up. Beyond those two main groups, high net worth borrowers with wealth is in assets rather than income, and fix and flip investors doing short-term project loans, all legitimate use cases that don't fit the conventional box. Let me walk you through the four main non-QM categories that I work with regularly. Category 1, alternative income documentation. This includes bank statement loans and 1099 loans. Instead of tax returns, we use 12 to 24 months of actual bank statements, whether they be personal or business, or the 1099 forms you received. This is where what self-employed borrower story gets interesting. I had a client last year, small business owner, had a down year in 2025. Income was declining, which killed the conventional loan. We went bank statement route and used gross deposits. Because it was a small business, we only had to use a 15% expense factor. Deal closed, home purchased. Category 2, DSCR loans, debt service coverage ratio loans. These are built for real estate investors. Instead of qualifying based on your personal income, we qualify based on the property's cash flow. If the rental income covers the mortgage payment, that's your qualification. Your investment property doesn't care what your W-2 says. Neither does a DSCR loan. And by the way, next Wednesday, I'm going to do a deep dive on DSCR specifically, including how it scales up to 8-unit properties. If you're an investor, subscribe because you don't want to miss it. Category 3, asset depletion loans. These are for high net worth borrowers whose wealth is in liquid assets rather than income, and they can be less than retirement age. It's also for retired executives, folks who sold a business with substantial investment portfolios. We use a portion of your liquid assets as effective income to qualify. Category 4, fix and flip loans. These are short-term project loans for real estate investors buying, renovating, and selling properties. Different underwriting entirely, focused on the deal, the timeline, and exit strategy. Down payment requirements are higher and calculated a little differently, but if you're an active flipper, these are how the deals get financed. Now, we got to talk about the honest trade-offs. Non-QM isn't right for everyone, and I need to name some of the reasons. First, rates. Non-QM pricing runs above conventional, but probably not as far above as you'd expect. If you're 80% loan to value or lower with solid credit, expect non-QM rates to run about a half a point to 3/4 a point above conventional financing rates. That's it. Not the horror story that most people expect. But here's the nuance. If you're pushing up to 90% to loan to value, or your credit's a bit lower, say a FICO under 680, that rate premium can widen to 1.5 or even 2% above conventional non-QM pricing. Non-QM pricing rewards equity and credit strength. Second, down payments. Minimums are higher than conventional. Bank statement loans start at 10% down. Asset depletion and DSCR loans typically want 15% minimum. Fix and flip requires substantially more and is calculated a little bit differently depending upon loan to cost and so on and so forth. I'm going to do a deep dive on that one later. And here's when I actually tell clients to wait. If you had a one-time down year and you're borrowing at a high LTV with a mid-600s credit score, that rate premium gets pretty rough. Sometimes waiting a year for conventional makes more sense than locking in a high non-QM rate today. Bottom line, when conventional works, use conventional. But when it doesn't, non-QM might be a nice bridge. If you're self-employed, an investor, or your income story is more complex than a W-2 can tell, head to johncobainhomeloans.com. We'll figure out which category actually fits your situation. Next Wednesday, like I said, I'm going to do a deep dive on DSCR loans, specifically including how they scale up to 8-unit properties for serious investors. So subscribe so you don't miss it. I'm John Cobain, Edge Home Finance, NMLS 374881. See you next week. Have a great day.